Hi everyone, welcome back to TJ Economics. Today we're going to be looking at different types of exchange rates. There are 4 different types you need to know about A-level and IB economics, so let's have a look. So we can define exchange rates as the value of one currency expressed in the terms of another currency. So for example, you'll quite often see Great British pounds in the form of US dollar. You might see Great British pounds in terms of euros or euros in terms of dollars. Effectively, what we do is we look at the value of one currency and compare it to the value of another. It's all about relativity and how much one is worth than the other. So, the basics and the very basics of how exchange rates work. And to be honest, exchange rates at its most basic level work just like supply and demand of any normal good or service. You can see there in this diagram on the left, we've got the value of the pound in the dollar. You can see that on the vertical axes. And our two curves, supply of the pound and demand of the pound. And that gives us the value of the pound, which is that little value on the left-hand side. And for example, say the Bank of England raises interest rates, that would increase hot money flows to the UK, demand for the pound would increase, and as you can see, demand for the pound has shifted from D pound 1 to D pound 2. That means the value of the pound would go from pound to dollar 1 to pound to dollar 2. And so, like I say, at its very most basic level, exchange rates work just like supply and demand and price of any other good or service. So we can put that in a little chain of reasoning if we want. Let's do that. So, for example, the Bank of England decides to raise interest rates as a form of contractionary monetary policy. Given that commercial banks will now offer greater returns on savings, those with large amounts of money will move that to the UK. In order to do this, they must buy GBP, increasing the demand for it, and we've got that diagram on the left that we've seen before, meaning that due to this increase in demand, the value of GBP will increase too. So like I say, exchange rates, very simple, work just like supply and demand. But we have 4 different types of exchange rate system that we see around the world. The first is a floating exchange rate, which is exactly what we've just described, is where the value of the currency is allowed to float completely freely, subject to the forces of supply and demand, completely freely. That's what's called floating. It can float up, it can float down, we don't intervene. We have managed floating, where by and large the currency is allowed to float freely, but if the currency goes too strong or too weak and is starting to, inhibit our ability to meet our macro objectives, then we'll step in. But there is no sort of hard and fast rule as to when we step in. There is no fixed limit, there is no fixed price. We just do it when we feel necessary. So it's managed, but it is by and large floating. Our third one then is semi-fixed, where again, we say it can float, but within defined bands. The difference between managed floating and semi-fixed is that semi-fixed has defined max and minimum values. If the currency value appreciates or depreciates outside of these bands, then the government or the central bank will intervene. Whereas managed floating, it's just how they feel, pretty much. And then lastly, fully fixed or pegged. The value of the currency is not allowed to float at all and is explicitly defined as the fixed value of another currency. That may sound a bit odd, but as we'll see later on, it actually is quite simple. So let's look at the first one then, a floating exchange rate. Not going to spend too much time on this, we've pretty much done it already. As we can see, we've got our value of the pound and the dollar, we've got the quantity, demand for the pound increases, therefore the value is going to increase, the value goes up. Things that may shift supply or demand of the pound, speculation, so people in the city, people in finance firms, hedge funds, those kind of things, they may bet on the price of the pound going up or down, and so that's going to affect supply and demand of the pound. Trade deficits and surpluses. If we run a trade surplus, that means we're exporting more than we're importing. That's going to affect the value of the pound and vice versa. Hot money flows, as we described earlier, if people move their money into or out of the UK chasing savings, that's going to affect the value of the pound. And FDI flows as well. Maybe more or less important for different countries, but certainly in someone like the UK, all 4 of those very well could affect the value of the pound. So let's move on to the more interesting ones then. Our second one, managed floating exchange rates. Our diagram is a bit different. We start with our basic supply and demand here. We've seen that before. The way I show it is with these sort of dotted bands. You can draw that as well. That's how I do it. And what we would say is that, like we say, there's no hard or fast fixed band that they will intervene. It depends on their economic aims and objectives. And so let's say, for example, demand of the pound increases and it goes above that band. If it goes above that band, the government might well step in to bring it back down. And likewise, if it goes too low, they might step in to bring it back up. And so I've put it in those dotted lines, those dashed lines, purely to show the fact that it's not a fix, it's not a legal limit. It's a sort of, it's a limit that people choose. Lastly, then, we have semi-fixed, where we have the defined bands that we spoke of earlier, the legal bands. And it's very similar to the managed floating exchange rate. However, instead of dashed lines, I've put it in very firm fixed lines. And so you can see they are lines across, and there is those fixed bands, like we say. So if the pound goes above that band, then we will step in. We absolutely will, because it's a defined band, it's a legal band, we have to. And so, like I say, if they do see that the value of the currency is going too high or too low above those legally defined bands, they will step in. They have to, they've got to. And then our last one, fully fixed or pegged. We call it fully fixed or pegged because, as you can see on the diagram, it's just a straight line. It's a fixed value. The value of the currency cannot deviate from that value. If it does, then the central bank will intervene pretty much immediately to keep the currency at that value. If it goes too high, they'll increase supply. If it goes too low, they'll increase demand. They will step in to keep it at exactly that value. And I'll show you some examples in a second to show you how that sort of looks. So let's look at some examples then. We've got some examples here of floating currencies. These are currencies, as we see, that are allowed to float freely, subject to the forces of supply and demand. Our first one then, GBP, the Great British Pound, as you might know, the dollar, the euro, the Canadian dollar, and the Australian dollar. 5 of the world's most important currencies, all of which float freely. And that might be because they're used in a lot of transactions to transport goods and services. In any case, they all float freely. And as you can see, here's a chart showing the value of the euro in terms of dollar over the last 10 years. And as you can see, by and large, it floats quite freely. You can see that over the last 10 years, the euro has been as strong as nearly $1.4. And today, as of recording this, which is summer 2022, it's actually for the first time ever reached €1 equaling $1. And so it's very interesting times, but the Eurozone and the European Central Bank allow that to happen. It's free floating. They're not going to step in to bring that back up because it's a free floating currency. Our second example then, managed floating, like we say, by and large floats freely, but they might step in if they feel necessary. The biggest example of this is the Japanese yen, definitely the biggest example of that, but we've also got the Peruvian sol, the Ghanaian cedi, the Indonesian rupiah, and the Uruguayan peso. So again, here's a diagram of Japanese yen to US dollar, and as you can see, again, by and large, it does float freely, but you can see it's not as volatile as other currencies. The Japanese central bank does step in every now and then, but by and large, it floats freely. Semi-fixed, then, as we said, within defined bands. So the Hong Kong dollar is defined within certain bands compared to the US dollar. The Bosnian mark, soon to be redundant, actually, they're going to join the Eurozone quite shortly. But at the moment, the Bosnian mark is within defined bands to the euro. The East Caribbean dollar, which as you can see there is used by about 8 or 9 Caribbean states, is compared to bands of the dollar. The Macau pataka is compared to the Hong Kong dollar, so indirectly compared to the dollar. And then the Tongan panga, I'm sure I've butchered that, is compared to a basket of major world currencies. And as you can see, this diagram here with the Hong Kong dollar, you can quite actually clearly see those bands. It is allowed to get as strong as 0.129 and as weak as 0.127, but not any higher or lower than that. As you can see, those are defined bands. It cannot go higher or lower or outside that limit. I think this is quite a nice diagram to show those bands. As you can see, there have been times where it's been really close to 0.129, and the Hong Kong Monetary Authority, the central bank over there, has stepped in to make sure it doesn't go too high. And there have been times in sort of late 2018 and early 2019 where it's gotten quite weak. And so they've stepped in then to affect it and make sure that it doesn't get too weak. But as you can see, within that band, it can do what it wants. Lastly then, fully fixed and pegged. The Saudi Riyal is pegged to the dollar. The Cuban peso is pegged to the dollar. The Eritrean nakfa is compared to the dollar. The Bulgarian lev and the Comorian franc are pegged to the euro. And you'll see here from this diagram, this is the Saudi Riyal versus the US dollar. You can see quite clearly, apart from that quite major blip in sort of late 2016, and especially from January 2018 onwards, the Saudi Riyal is and has always been, or as close to has always been, one Saudi rial is worth 0.26 US dollar. And so it's quite clear there, Saudi Arabia and the Saudi central bank and the Saudi government will work to make sure that the Saudi rial is always worth 0.266 US dollar. And the Saudis do that because they export a lot of oil, which is sold in dollars. And you'll see, if you go back to our examples here, a lot of other countries may well do that for different reasons, but the Saudi reason is because they export a lot of oil. So a summary then. There are 4 key forms of exchange rate you need to know. Firstly, floating, allowed to float freely due to supply and demand. Managed floating, allowed to float freely due to supply and demand within reason, we can say. Semi-fixed, allowed to float freely due to supply and demand within defined bands. And then fixed, firmly fixed to an exact value of another currency. And so we get increasingly more control over the value of the currency until we get to fixed, where it's just defined as an exact value of another currency. So thank you for watching. I hope you've enjoyed this video. Hopefully the diagrams have been useful. Feel free to go back and screenshot, print off, save any of the diagrams or the tables that we've looked at or the examples. Feel free to do your own research. Comment below what you'd like me to do. Follow me on Instagram and Twitter. Subscribe here, like the video, and I'll see you all soon.